Hello, my name's Gareth Lewis and I'm the project leader for Emerging Trends in Real Estate Europe 2016, a joint undertaking between PwC and the Urban Land Institute. Now in its 13th year, the report reflects the views of over 550 senior leaders from across the industry who completed surveys or were interviewed as part of our research. More than ever before, this has allowed us to gather a unique perspective on the outlook for European real estate, covering real estate investment, development, finance, and other trends impacting the market. Today, I will be sharing the findings of the 2016 report with Simon Hampton, who leads our deals practice here in the UK. Simon, the overall mood coming back from the survey is very positive, although there are some growing undercurrents of caution, more so than in 2015. Are we starting to see the end of the real estate cycle, and will this happen in 2016?
It's quite a complex question on a Europe-wide basis. I think I would say this: yes, we're clearly closer to the top of the cycle in 16 than we were last year. The UK in particular has seen a lot of investment and has got quite expensive. There are still some good mitigants though. Interest rates are still low and operational rental outperformance is still strong. So most people, I think, are feeling reasonably good about the UK. Europe on the whole is even further behind and is lagging. So I think we can feel a little bit more comfortable about some of the European economies. And indeed, we've seen a lot of capital shift from the UK, particularly the southeastern corner of the UK, into Europe on the basis that Europe will lag. Do I think 2016 is the end of the cycle? No, I don't, but we're certainly getting close.
55% of respondents in the survey thought that the amount of equity available for financing or new investment in 2016 would either increase or significantly increase, but that's notably lower than the figure for 2015, which was 71%. What do you think's happening with global capital flows, and how will this be different in 2016 to 2015?
Well, I think in 2015 we had a bit of a perfect storm. Most of the private equity funds found it very easy to raise new money. The capital markets, both for equity and debt on a Europe-wide basis, were very open and volume of transactions was extraordinarily high. And we also had an awful lot of money coming out of Asia, not just China, but broad-based pension funds and high net worth. And all of that money was converging itself on Europe in a little bit of a perfect storm. This year, when you compare 16 to 15, the capital markets have been a little bit more volatile, particularly the bond markets, but also in equity IPOs. And some of the geopolitical activity that we've seen is causing a degree of nervousness in Asia, particularly in China. So I think as we look forward for 16, we have to assume a little bit more caution in terms of the availability of capital for Europe.
And thinking about where that capital is going to go, the leading cities for investment prospects in 2016 are Berlin, Hamburg, Dublin, Madrid, and Copenhagen. Familiar names to last year, but any surprises for you there?
Yes, a couple. In the same way that we were somewhat surprised last year with the inclusion of Athens, this year with the move of capital out of the southeastern corner of the UK and much more focused on Europe, I'm somewhat surprised that, say, Milan or more of Italy isn't included, or perhaps Holland, or indeed Birmingham as a regional UK centre.
And investors in this year's survey are increasingly favouring the alternative sectors and operational assets, with 41% looking to take the plunge into alternative sectors as opposed to 28% last year. Healthcare, hotels, student accommodation and data centres are all expected to perform well in 2016. Is this simply a case of prime assets and mainstream sectors being overpriced, or is something else happening there?
Well, I certainly think that the core sectors, prime assets, have become very expensive. So clearly, as people look at where they're going to focus, if you can become a bit more differentiated and focus on something which requires operational expertise, there's less competition there for deals. So I think part of it is that people feel deal doing will be somewhat easier in those sectors. And there's a lot of evidence that backs it up. The volumes across private rented, hotels, serviced office, student housing, healthcare, they've been very, very high volume activities for us in the last 24 months from a transaction volume perspective. The second thing I think that's going on there, though, is that it's those operational asset classes which are capturing the upside at the moment. There's quite a lot of GDP growth, there's quite a lot of robust rental upside, and it captures very quickly through the operational side. The third thing that's going on is there are some interesting things going on with megatrends and urbanization and the built environment, and a number of those sectors play into that, in particular private rented and student.
Thank you, Simon. In summary, lots of positive sentiment in 2016, but clearly an industry responding to the impacts of urbanisation and social demographic change. I hope you have found this useful, and the full report is available on the PwC website.